Alexandra Krystalogianni. You are Director Insight and Investment Strategy at Avison. Thank you for joining us on BiTV.
Thank you for the invite.
Last week, the ECB announced its first rate cut since 2019, following a series of drastic rate hikes over the past 2 years. What could be the main implications of this cut on European real estate markets, do you think?
Well, real estate, both on the commercial and residential side, is very sensitive to changes in interest rates and fixed income pricing. So overall, I would say it's a very welcome move. Having said that, the first 25 bips rate cut will not have a big or immediate impact on borrowing costs, as this has already been priced in by the markets. If one looks at 2 or 5 year swaps, they have barely changed since the ECB announcement. What is most important, I think, is the impact on sentiment. It sends a positive signal to the markets to the extent that it will be followed by other rate cuts. As to use President Lagarde's words, is that it is very likely that the Thursday cut was not a one-off, but it's the start of a dialing back process. So overall, it will boost more sentiment among investors and operators, and they will start looking again at real estate with the hope that a new cycle is very soon to begin.
Yeah, because speaking of sentiment, European real estate markets have slowed considerably. I think we can say that over the past 2 years. Because investors waited for greater macroeconomic clarity. Is this first rate cut likely to lead to maybe an upturn in momentum? When you say it's building a little bit better sentiment, do you see this as maybe a nice breaker for European real estate markets?
Sure, we think that because there is a lagged effect to consider also that activity will start normalizing by next year. And it's also important to have in mind that monetary policy easing is good, but also real estate is very closely linked to what's happening in the real economy. And as we expect interest rates to come down, but stabilize at levels higher than what we were used before, this means that most of the performance will come from income and income growth. So it is crucial for the investors to be in the right sector.
And obviously, the elephant in the room, the Fed chose not to cut rates in June. How do you think this might affect the European real estate markets compared to their American counterparts?
Well, the Fed's decision on one part, it was based on different macro fundamentals, but one can say it is also to some part a political decision because of the coming presidential elections. Overall, in the medium term, we wouldn't see a big divergence, a differential between US and European interest rates. The markets are expecting up to 1 to 2 cuts from the Fed this year, 2 cuts from the ECB. So we wouldn't expect a significant appreciation of the US dollar that could lure US investors into the European real estate markets. And also to add here that real estate investors really when they take the decisions to invest overseas, they are not based on exchange rate changes, and especially for US investors, when they are looking into Europe, they are more value add opportunistic, so they look at total return performance. So overall, we may see some more US capital coming in, maybe because of a favorable exchange rate or the European upswing to start first on the real estate markets, but it will not be a game changer.
Alexandra, Krystalogianni, thank you so much for taking the time to share with us this valuable insight. Thank you all also for being with us, and we'll see you soon on BiTV.
Thank you. Bye.